This is Sarah. She lives in the United States, where she pays in US dollars almost every day. Now she's flying to Spain, which uses the euro. When Sarah goes to swap cash, she notices that $1 gets her less than €1. It converts to about 80 cents. Later, she heads to Thailand, where $1 turns into thousands of baht. Wait, what's going on? Why does money have different values? Why isn't $1 equal to €1 and 1 baht? And why do exchange rates wiggle around every second? In this video, we're going to explore currencies, exchange rates, and why money isn't just equal. Before we dig into the reasons, let's do a quick history of what money has been. For a long time, many currencies were linked to precious metals, especially gold. This was the gold standard. Under that system, a country's money was backed by a specific amount of gold. The US dollar, for example, was once tied to a fixed quantity of gold. That kept exchange rates relatively steady because a government couldn't simply create more money unless it had more gold to back it. In other words, it discouraged printing money without limits. But as economies expanded and global trade intensified, especially through wars and crises, maintaining enough gold for every unit of currency became harder. By the 1970s, most countries shifted to fiat money. Fiat money has value because the government declares it legal tender and people trust and use it. There's no direct backing by gold or silver. Some people jokingly call it fake money, but in reality, its power comes from policy and demand. With fiat money, value depends on whether people want to hold and use it. If lots of people and institutions want a currency, they compete to get it, and its value rises. If people don't want it, the price falls. So the value of fiat currency comes down to supply and demand. That's why the money of larger, more stable economies, like the US dollar, tends to be in higher demand. Meanwhile, currencies from economies battling instability or extreme inflation can fall sharply because even locals try not to hold them. So in this video, we're going to see how supply and demand shape the value of money. Section 1. Inflation. Inflation is when money loses purchasing power over time. In simple terms, there's more money chasing the same or fewer goods and services, so prices rise. When a country has high inflation, its currency usually weakens. Why? Because people don't want to hold a currency that's rapidly losing value. Imagine in 2022, you could buy 2 loaves of bread for $10, but by 2024, that same $10 buys only 1. A well-known case is Zimbabwe. Decades ago, the Zimbabwean dollar was stronger than the US dollar. But after severe policy mistakes, failed land reform, economic mismanagement, corruption, sanctions, and uncontrolled money printing, the currency collapsed. At one point, it took hundreds of thousands Zimbabwean dollars to buy 1 US dollar. Authorities tried redenominating and relaunching the currency several times. Ultimately, people and businesses began using foreign currencies like the US dollar and the South African rand. Section 2. Interest rates. You've heard about interest rates, the percentage cost of borrowing money. If you borrow $1,000 at 10%, you owe the $1,000 plus $100 interest after a year. Central banks, like the Federal Reserve in the US, influence key rates. When a country's rates are high, investors can earn better returns on deposits and bonds there. To invest, they must buy that currency, which raises demand and typically strengthens it. Consider government bonds. Buying a $1,000 bond at 5% for 10 years means you're lending the government $1,000 and receiving $50 per year for a decade, plus your $1,000 back at maturity. If US rates rise above euro area rates, global investors may sell euros and buy dollars to capture the higher yield, lifting the dollar. If US rates fall relative to others, the opposite can happen. Less demand for dollars, and the currency can soften. But there's a trade-off. High rates also make borrowing expensive for families and businesses. Fewer mortgages get taken out, fewer projects get funded, and growth can slow, pushing unemployment higher. That's why central banks raise and cut rates carefully based on inflation, growth, and financial stability, not simply to prop up the currency. Section 3. Country conditions and foreign investment. When China opened to foreign investment in the late 1970s, global companies set up operations there. To build factories, lease land, and pay workers, they needed renminbi, yuan, increasing demand for China's currency and bringing in capital. That's why countries court foreign direct investment, FDI. It can support the local currency and create jobs, but investors are picky. They want stable politics, predictable laws, and reliable infrastructure. If a government lures companies with low taxes and then suddenly hikes them, investors can lose money and confidence. In contrast, stable rules-based environments attract long-term capital, which supports the currency. Section 4. Exports and imports. Trade flows matter. When Japan exports cars, foreign buyers ultimately need yen to pay Japanese firms, supporting the yen. When Japan imports coal from Australia, Japanese buyers need Australian dollars, adding demand for AUD. Most countries try to export more because it pushes others to buy their currency. A famous structural force is oil. For decades, many oil contracts have been priced in US dollars, ensuring constant global demand for dollars because most countries need oil. That helped the dollar become the world's leading reserve and invoicing currency, a system often nicknamed the petrodollar. Some energy producers have explored accepting other currencies for certain deals, but the dollar's role remains central. On the other hand, small island economies with limited exports, think places like Tuvalu, don't generate widespread foreign demand for their currencies. In practice, they often rely on stronger foreign currencies, like the US or Australian dollar, to make trade and pricing easier. Section 5. Fixed value. Want stability without constant market swings? Some countries peg their currency to a stronger one. That means they fix or tightly manage the exchange rate. For example, Brunei maintains its currency at par with the Singapore dollar under a long-standing arrangement. One Brunei dollar equals one Singapore dollar, and the notes are widely interchangeable. Another example is Belize, which pegs the Belize dollar at 2 BZD equals 1 USD. For travelers, it's simple math. No need to check a live rate, just double or halve. But if the anchor currency drops or its central bank changes course, the pegged country feels the impact too. In other words, if one currency lives, the other lives. If one struggles, the other struggles. So these are big reasons currencies have different values. Your next question might be, why not just use one currency everywhere, a world dollar, so we can ditch exchange rates and all the hassle? Sounds neat, but it's not so simple. Take the euro. It's super convenient inside the Eurozone. Travel and trade are easier without changing money, but members give up national control of monetary policy to the European Central Bank. One country can't tweak interest rates just for itself without affecting everyone else. When Greece faced a severe debt crisis in 2009, stress spread across the Eurozone, highlighting how a shared currency means shared risks. Now, should a country try to make its currency as strong as possible? Not necessarily. Different economies have different needs. Heavy importers, like Singapore, may like a stronger currency. It makes imported goods cheaper for households and firms. Heavy exporters, like China, may prefer a more competitive currency so their products look cheaper abroad. That's why you sometimes hear accusations of currency devaluation, keeping the exchange rate lower to aid exporters. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.